Welcome to Celebrity Investing, your go-to source for insights, tips and updates on navigating the exciting landscape of personal and global finance. Please like, share and subscribe for more exclusive content. This is part 1 of Inflation Survival Guide, protecting your finances from rising costs. Have you ever wondered why prices seem to creep up every year? That's inflation at work, and it affects your daily life more than you might think. Inflation risk can erode your purchasing power, making everything from groceries to gas more expensive over time. Understanding inflation is crucial for anyone looking to protect their personal finances. Inflation risk isn't just about rising prices, it's about the impact on your savings, investments, and overall financial well-being. If your income doesn't keep pace with inflation, you could find yourself struggling to maintain the same standard of living. In this video, we'll explore what inflation is, how it affects you, and what steps you can take to manage this risk effectively. Get ready to take control of your financial future by gaining a better grasp of inflation risk. Understanding inflation. In simple terms, inflation refers to the increase in the overall price level of goods and services in an economy over a period of time. It's essential to understand the causes and types of inflation to grasp its impact on your daily life and financial decisions. Causes of inflation. Demand pull inflation. One of the primary causes of inflation is demand pull inflation. This occurs when the demand for goods and services surpasses the available supply, leading to an increase in prices. For example, during holiday seasons, the demand for popular toys may exceed the supply, causing prices to rise. Cost push inflation. Another significant cause is cost push inflation, where the production costs of goods and services increase, leading to higher prices for consumers. For instance, if the cost of raw materials like oil rises, this cost is often passed on to consumers through increased prices at the pump. Types of inflation. Moderate inflation. Moderate inflation refers to a steady and controlled rise in prices over time, typically in the range of 2–4% annually. This level of inflation is considered healthy for an economy as it encourages spending and investment. Galloping inflation. Galloping inflation is characterized by a rapid and escalating increase in prices, usually ranging from 10% to 100% annually. This type of inflation can erode purchasing power quickly, leading to economic instability. Hyperinflation. Hyperinflation is an extreme form of inflation where prices skyrocket uncontrollably, often exceeding 50% per month. A classic example is the hyperinflation experienced in Zimbabwe in the late 2000s, where prices doubled every day, causing severe economic hardship for citizens. Understanding these causes and types of inflation is crucial for individuals to make informed decisions regarding savings, investments, and financial planning, as inflation directly impacts the purchasing power of money. Being aware of how inflation affects prices and the economy can help individuals navigate economic fluctuations and protect their financial well-being. Inflation risk and investments. Inflation risk can have a significant impact on investments, causing the value of assets to decrease in real terms over time. Understanding how different asset classes are affected by inflation and implementing effective strategies to hedge against this risk is crucial for investors looking to protect their portfolios. Asset classes affected by inflation. Stocks. Inflation can affect stocks in various ways. While some companies may see an increase in revenue due to rising prices, high inflation can also lead to reduced consumer spending, impacting corporate profits and stock prices. Investors often view stocks as a hedge against inflation due to their potential for long-term growth. Bonds. Bonds are especially vulnerable to inflation risk as the fixed interest payments they provide can lose purchasing power in inflationary environments. Treasury inflation-protected securities, TIPS, are specifically designed to mitigate this risk by adjusting the principal value of the bond in line with inflation. Real estate. Real estate is considered a traditional hedge against inflation as property values and rental income tend to increase with rising prices. Investing in real estate properties or real estate investment trusts, REITs, can provide a tangible asset that retains value during inflationary periods. Commodities. Commodities like gold, silver, and oil are often seen as safe haven assets during inflationary times. Their intrinsic value tends to rise with inflation, making them attractive investments to preserve purchasing power. Strategies to hedge against inflation. Investing in TIPS. Treasury inflation-protected securities, TIPS, provide investors with a guaranteed real return above inflation, making them a popular choice for hedging against rising prices. These bonds adjust their principal value based on changes in the consumer price index. Real estate investments. Investing in real estate properties or REITs can offer protection against inflation by providing rental income that tends to increase with rising prices. Real estate assets have historically outpaced inflation over the long term, making them a valuable addition to a diversified portfolio. Inflation is an economic reality that affects everyone, eroding purchasing power and increasing the cost of living. Protecting your finances from rising costs requires a proactive approach and a sound strategy to mitigate its impact. Understanding the nature of inflation and employing practical measures can help preserve your financial stability. Inflation is the rate at which the general level of prices for goods and services rises, leading to a decrease in the purchasing power of money. Several factors contribute to inflation, including increased demand for goods and services, rising production costs, and expansionary monetary policies. While moderate inflation is a normal part of a healthy economy, high inflation can significantly strain household budgets and savings. One of the most effective ways to protect your finances from inflation is through prudent investing. Investments that historically outpace inflation, such as stocks, real estate, and commodities, can help maintain and grow the value of your assets. Equities, particularly those in sectors like technology and healthcare, tend to offer better returns over time. Real estate investments provide a hedge against inflation, as property values and rental income typically rise with inflation. Additionally, commodities like gold and silver are often considered safe havens during inflationary periods. Another important strategy is diversifying your investment portfolio. Diversification involves spreading your investments across different asset classes to reduce risk. A well-diversified portfolio might include a mix of stocks, bonds, real estate, and commodities. This approach can help cushion the impact of inflation on your overall investment returns, as different asset classes respond differently to economic changes. Adjusting your savings approach is also crucial. Traditional savings accounts may not offer returns that keep pace with inflation. Consider placing some of your savings in inflation-protected securities, such as Treasury inflation-protected securities, TIPS. TIPS are government bonds specifically designed to protect against inflation. Their principal value adjusts with inflation, ensuring that your investment retains its purchasing power. Managing debt effectively can also safeguard your finances from inflation. Fixed-rate debt can be advantageous during inflationary periods because the value of the debt diminishes as inflation rises. Conversely, avoid accumulating high-interest debt, as the cost of servicing such debt can increase with inflation, putting additional strain on your finances. Keeping an eye on your expenses and budgeting carefully can help you manage the rising costs associated with inflation. Identify areas where you can cut back and prioritize spending on essential items. Regularly reviewing and adjusting your budget ensures that you remain financially resilient, even as prices increase. Maintaining an emergency fund is another critical aspect of an inflation survival strategy. An emergency fund provides a financial cushion that can help you cover unexpected expenses without resorting to high-interest debt. Aim to save 3 to 6 months' worth of living expenses in a readily accessible account. Finally, staying informed about economic trends and understanding how inflation impacts different sectors can help you make more informed financial decisions. Knowledge is power, and being aware of inflationary pressures allows you to adapt your strategies accordingly. Inflation, the gradual increase in prices and the corresponding decrease in the purchasing power of money, poses a significant challenge to financial stability. As costs rise, maintaining and growing your wealth requires strategic planning and informed financial decisions. This guide outlines key strategies to protect your finances from the erosive effects of inflation. In summary, protecting your finances from rising costs due to inflation involves a combination of smart investing, diversification, adjusting your savings approach, managing debt, budgeting carefully, maintaining an emergency fund, and staying informed. By implementing these strategies, you can safeguard your financial well-being and navigate the challenges posed by inflation effectively. By understanding how different asset classes are influenced by inflation and implementing effective strategies like investing in tips or real estate, individuals can safeguard their investments against the erosive effects of inflation, ensuring long-term wealth preservation and growth. Stay tuned for part 2 and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.